This conference will now be recorded.
Yeah, I think it worked. You hit record and it worked. So let's see if that works. Because in my go-to, it actually showed that it was recording. So I
Okay,
think it
so
should be
I
good.
so speeding up from here. That's good.
Yeah, I think it's actually picking up whatever feed there is.
But bravo,
Okay.
all yours.
All right. So we've been talking for the last couple weeks about spot gamma levels, specifically how to trade with them, or what I'm doing with them, and specifically, kind of just to do an education on what they are. And a couple people have expressed interest in that. So I'm going to go from the beginning, just the basic 10,000 foot level, gamma exposure in the options market, what it is. And I'm not going to get into really super technical details with it, because I don't think you need to know a ton of technical details to trade with it. And then I'm going to show you hopefully one thing that you can use by the end of this to be able to have an edge in the markets. And it's something that I use. So just, trading's hard. You can lose a lot of money. Everything I'm talking about here is working now, but it probably, it's going to break at some point in the future. That's just how markets work. And I'll actually get into, after COVID and why I think some of this stuff actually works so well right now. So this is for education. Hopefully you get something out of it. So gamma exposure, it's a big buzzword, I think, with trading. A lot of people kind of throw it around, and oftentimes I don't know what everybody else hears, but I hear stuff like, oh, we're in a negative gamma environment. Oh, we're in a positive gamma environment. Oh, it's high gamma. Oh, it's low gamma. And I don't know necessarily. I mean, all that stuff means something, but I don't particularly use it, in my trading that much. What I will show you, what I do use is where the gamma is at specifically. So the picture you're seeing up here in the top right is just the options chain downloaded from the SIBO website. So you can go to SIBO, I think SIBO.com, and there is a ticker search where you can get this data. And actually, SIBO has the best data, even though it's delayed. But if you get it, right before the close, or right in the morning after the open, it's usually pretty good. And you're always looking at, obviously, the day before's data that's all tallied up. But that's how most people trade with it anyway, unless you're obviously really fancy and you have real-time data, like some of these. Some sources are starting to have that kind of thing, but I don't think it's really super important. You can use the options chain to specifically calculate for yourself gamma levels. So what am I talking about? I don't know if you can see my cursor. Can you see my cursor, Fari, right here?
Oh yeah, oh yeah. Yes, I
Okay,
can.
you can see it. Okay. So this is the gamma level right here. And what is the gamma level? Well, the gamma level is just how much the delta level changes. Well, now it's getting like, well, why do we care about that? Well, the delta is the big important thing. Market makers use delta for a variety of reasons, but mostly they use it to balance their books. So like if they have a bunch of shorts and longs, or if they have a bunch of sold puts and a bunch of long calls, they got to make sure, usually at the end of the day, that they're trying to be delta neutral. So what you end up with is a situation where the gamma is just the first derivative of the delta, if that makes any sense. So you're trying to get an edge by trying to figure out, are the deltas going to be moving up, or are they going to be moving down? And for a long time, everybody kind of wrangled with like, well, how do you know what the market makers are doing? Well, somebody just came out and said, basically, here's most of the time the market makers are long the calls. In other words, they're buying it when other people are selling calls. So like, let's say you had some shares of SPY and you're going to sell calls, which is a really popular thing with retail investors. It's popular with funds as well. So you would sell the calls, a few percent above wherever you're at, knowing that generally during the week, we don't get some crazy high move that's going to take you out. you'll sell calls up there, you'll make a little bit of extra money, and then you'll juice your returns by 1 or 2% a year or something like that, right? Well, the market makers are constantly on the other side of that trade, taking the other side of the trade. So what does that mean? That means for the calls, you're going to assume the gamma is positive. That's it. So, and then for the puts, you're going to assume people are buying the puts for insurance protection because they're scared, you're going to get a big move down, right? So that's just generally the way markets work. And so you're going to assume that the gamma on the puts is actually negative. Now, why does that matter? So you can see here, there's like 0.126 is the gamma here. There's 0.126 is the gamma here. But at the 439 strike, there's only 185 calls, but there's 10,000 puts. So what does that mean? Just off the top of your head, there's more negative gamma at that strike. That's it. That's all it means. And the reason you know that is because there's 10,000 of those. You multiply it by 0.1526, and you know that that's a negative number because you're assuming they're all going to be a negative number. You multiply 0.1526 times 185, and that's a slightly positive number, right? And the other thing you're going to do is you're going to multiply everything by the last underlying price of the index. So it changes like even second to second. But when I trade with this stuff, I'll go through, and this is what I used to do. I used to take every strike and every gamma and every open interest and every end of the day price, multiply them all together, and then add them up. So for 438, I'd be like, multiply this times this, add it to this times this, and then I subtract the puts from the calls, and you end up with a graph. All right. And the graph looks kind of like this. Now, this is really small to read. I took this from the Spot Gamma website today. And we went through this a little bit earlier. I just said typically the market makers, right, are long the calls. They're typically short the puts, which means they're selling the puts. That means they're buying the calls, right? And people sell the calls, and people like to buy the puts. That's all that means. Each of these big spiky bars is the result of adding just the gamma at this particular strike and then showing just the negative gamma for the puts at that particular strike as well. So when you see this enormous long bar, then you know that there is an absolute large amount of positioning in the options market at that strike. This happens to be 450 SPY or 4,500 SPX. And we know we've basically been wiggling around that for quite a while now. And part of that was because into September OPEX, it was just very crowded in that area of the market. So these two bars would have been much bigger in size before September OPEX. And this strike is actually still big into December as well. So the other thing to notice is that these spiky bars are at discrete levels. So like this is 450, this is 445, this is 440, right? And so one of the things it's very typical that you'll notice, even if you just look at the options chain, it's not rocket science. People tend to mentally gravitate to multiples of 5. There's not a lot of usage of individual, like 439, 438 on SPY in terms of strike prices. It's very typical for them, especially big orders. They like the round numbers. It's just the thing. It's just a thing you see in markets. So very typically, a crude assumption would be most multiples of 5 on SPY are very large levels of options positioning. So that would be a very crude assumption. But Spot Gamma calculates all this stuff for us automatically, so we don't have to take a spreadsheet out and do it. But you can take a spreadsheet out if you want to and do it. And the very basic idea is that you would use any of these levels as basic support and resistance. So you'd use it the same way you would like a VWAP. So if you're coming down on top of it from above, you would expect it to bounce or, be like a speed bump on the way down. And the reason is simple. You've got a lot of market makers looking at their books going, oh, okay, well, now how do I do this? I'm at some strikes where I know a lot of people have options positioning. Do we defend it or do we let it go down? And a lot of that would have to do with their P&L. They want to screw the most amount of people possible so that they make the most amount of money. They want the most options to expire worthless, right? So these levels get particularly sensitive when you get into areas of time like at the end of monthly OPEX, when the options themselves don't have any time value left. Then they're not worth nearly as much to the market maker, so they're willing to move them out or buy them up, really quickly. And so you can get some weird moves at these levels of support and resistance, particularly going into options expiration days. And then we've noticed it even not just, with your traditional monthly OPEX, now that we have weeklies and zero data expiration trading. You might have event risk where like it's a big CPI day and all of a sudden everybody's got a lot of options, and you'll be able to see it because there'll be a lot of positioning tied to that particular expiration date. And you'll know how, well, after the CPI, I can expect a pretty big move because all those options are either they're going to close up, like, within a half hour, 45 minutes after the data is released. Most of it's going to get washed out. So we would typically use those levels to trade against. So this is just an example from this morning of the type of stuff that you would get from Spot Gamma. There's a bunch of terms on this list. I'm not going to focus on every single term on this list. Just suffice it to say, for simple purposes, every one of these levels can be a level of support or resistance. Okay, some of them are more important than others. Usually the ones with one attached to them, or a call wall and put wall, those two define where the highest levels of gamma are associated with calls. So there's on the NQ, that's where all the calls live. And then way down here, about 300 points lower, well, 1,000 points, so 1,300 points lower, that's where all the puts live. So that's kind of a big range, 1,300 points to be trading in. And that range is probably going to persist probably into December, given the way the positioning is set up. But the one I want to focus on today is this one. It's called Volatility Trigger. And oh, by the way, you can add these levels. So what I'll do typically in the morning is I'll post, what we got going on. These are the levels, and you can choose how many you want to add, or if you only want to add the ones that are near where price is at, currently in the day. Like obviously this one at 16,000. You're like, oh, why would I put that on my chart? You wouldn't. 14,000 down here, you might not want to put that in there either. But any of these right around here where we're trading could be pretty useful to be able to know, hey, this is an area we would expect to bounce or a level of support or resistance. And you can add, there's an indicator called custom line. I think there's one on TradeStation that actually lets you plot 4 lines at once. So if you did one of those, applied the call wall, the zero gamma, the put wall, and the volatility trigger, you'd probably be doing fine. And then if you really wanted to, you could get fancy with some of the larger gamma strikes. Those are, again, they're just areas in the market that tell you where there's a lot of options positioning. So those areas of the market are real areas where market makers are making decisions about whether or not to buy or sell futures, because that would be how they would hedge, right? So we can talk about market maker hedging behavior. So this doesn't have to be complicated either, okay? We were talking earlier, market makers are usually long in calls. They're usually short the puts. That's not 100% accurate. People do all kinds of fancy stuff with options now. We do have 0 DTE expirations, and a lot of retail traders are getting into selling options, kind of like little mini market makers. I see that pretty often. A common strategy would be like to sell iron condors. And you don't have to know what iron condors are, but I'll tell you that an iron condor usually is a trade that wins 90% of the time, and it attracts a lot of people because they can win a lot and it feels good. But when it loses, if you don't know what you're doing, you can lose a ton of money trading iron condors. So I see that often with retail traders that want to sell options these days. But for the most part, most people are still selling calls on the stock that they own, and they're still buying puts on the stock that they own as insurance. So that's how we're going to treat it until things change, and it's working well. That assumption works well. So what does that mean to get one level deeper than that? Well, typically that would mean a market maker is going to be selling into the strength. So like if the market's going up, up, they would be selling futures into that strength, and they're typically going to buy into the weakness. So that type of behavior is not as common as the actual positioning where, they're typically long calls or short puts. And you're thinking like, well, what are you talking about? Like, wouldn't they just act the same way every time? And the answer is absolutely not, because the prices of options do not change in a very like linearly predictable, simple way. There's a lot of things that go into pricing options, suffice it to say, including skew and who's buying what and where people are buying options. But we don't have to get into any of that. But let's suffice it to say about 70% of the time, market makers are supporting the market by suppressing volatility. Okay. That means if the market's going up a lot, you're going to see those guys try to knock it back down, and if it's going down a lot, you're going to see those guys buying it and try to support the market. I'm interested in talking about, and I'm interested in trading about that 30% of the time where the market makers are not acting normal. Okay. And you would think that, how would you be able to know that? Well, that's where spot gamma helps a lot. There are times when market makers, because of the way that their books are positioned, because of the where the strikes are, because of where the people bought options and when they bought them, where market makers are, they're going to be in a position where they've got to sell the market down as it goes down. And this would be like in a circumstance where, say, like a lot of people have bought puts right underneath a key support level, and there's a lot of exposure maybe the market maker has in terms of, actual, the money they could lose. So they're going to be pretty quick on the draw about making sure they're selling futures to get ahead of where any puts they have on their books could expire, like in the money, And so all that stuff gets calculated. You don't have to worry about it, because spot gamma calculates something called a vol trigger. The vol trigger is supposedly the level where market makers will start to kind of change their hedging behavior. Okay. You can think of it, instead of volatility suppressing, and that goes both ways. That's important to remember. So if the market goes up, they're going to sell it. Market goes down, they're going to buy it. Instead of doing that, market goes down, they're going to sell it. Market goes up, they're going to buy it. What does that mean? That just means that the ranges expand. So this is just a level that tells us when the ranges are likely to expand. And it's a level that tells us, well, we can expect things to be different. So like the simplest way I used to think of it is, oh, well, VIX should go up if we're under the volatility trigger. We should have higher volatility, which means the VIX should go up. That doesn't really necessarily happen anymore, because a lot of people trade very short data expiration options now. They're 50, 60, 70% of the market notional, and it's every day that changes. So you can get large range days underneath the volatility trigger and still have VIX at like 12 or 13. And we've seen that actually for the last 3 or 4 days. We've seen VIX go up, but we're not talking about like 20 or 21 VIX. And we are getting some pretty decent moves, like 1% moves. Like today is not a great day. But what I want to show you on this graph is just this yellow line is that vol trigger level. Okay. That again, that's the level where the market makers would change their hedging behavior, and you might expect larger range days. Why are larger range days? Why is that even useful? Well, day trading is much better when the ranges are bigger, like way better. And if you knew the ranges were going to be bigger, that would be something very valuable and very useful to day trade with. Okay. And so I've shown these purple bars where the close of the bar is underneath the yellow line. So we've closed underneath the volatility trigger, and we can expect the ranges to expand. So that alone would get me interested more in day trading, right? You would have bigger ranges, and you'd be capable of, there's just more real estate intraday to tread. So that gives you more opportunities as a day trader to make more money. That's one of the knocks on day trading, is that typically you're not getting exposed to gaps up, and you're not getting exposed to a very large move. You're stuck in the range of the bar. So you just don't get, it's hard to expect the returns of holding overnight unless you can figure out how to trade these larger range days. And then the other thing I'll point out is oftentimes, like, look at this. Look how many bars we closed underneath that vol trigger when we were on our initial push down on the, this was the debt downgrade, I think was what it was, or whatever, the United States debt downgrade. So it showed as a level intraday clearly of resistance all the way down, which tells you market makers were selling because people bought a bunch of puts and they were exposed as it went down. So they just exacerbated things and sold on the way down. They also bought on the way back up. So these are all pretty decent size range days here. And how can I use the vol trigger if I know there's more volatility? What else could I use to overlay that to actually have a decent edge in markets so that I can day trade with it? Well, one of the things you can do, and this is very rudimentary, so I'll show you guys this. This is the kind of thing that I do. I don't trade like every single day. I want to trade when I know I've got at least some loaded dice on my side with the dailies, right? I just plotted the MACD, the plain old MACD. It's just the regular MACD indicator on the bottom. And I want to show you every time we close underneath the vol trigger, so we can expect higher ranges, right? That 30% of the time when the market makers are exacerbating volatility. But we've also started positive momentum to the upside. And we have better indicators than the MACD for doing momentum. I just needed something I could use to back test here easily. It doesn't have to be, there are much better ways to do this. I'm just saying this is a simple concept you can understand. When the trend is up and the MACD says we got positive momentum, right? And we close underneath these volatility trigger levels, you can expect that now you're driving a car going up, but you've also got, or let's say you're sailing a sailboat. You've moved the direction to up, kind of. Well, the odds are it's going to go up, right? And you now have a wind at your back because market makers, now are actually going to have to buy the futures to send it up because they're trading in the direction of where things are going. They're not suppressing volatility. They're increasing volatility. And one of the most profitable quadrants of trading in the markets is if the trend is up and it's very volatile. That means the trend is going up and it's going up at a very high rate. That's not a very common market condition, okay? So just to give you an idea, this happens about 8 or 9% of the time in markets. So if you're trading, you're day trading, in those 8 or 9% of the days, you want to hit it really hard to the long side because you have the wind at your back. Things are going up in general on the dailies, and you've got support from the market makers buying. So I'll show you the equity curve here of that little, just all this is buying when the thing is underneath the line and the MACD histogram's green, and just selling it the next day. There is no, it's just rote, simple, they're just two rules, right? So like I said before, if momentum is trending higher and we're closing under those spot gamma levels, the volatility trigger levels, it definitely tends to be a nice time to be buying stocks and holding them for that 1 to 2 day period. So that's a boost you have over 1 to 2 bars. And then I'll show you here, the trend has been particularly true since the COVID bottom. That's where the COVID bottom was in the markets. And I don't have a ton of data before 2018 or something, because spot gamma had only been around for a little while before COVID, but it had been around for a couple of years. So you could see that it wasn't a thing. Look how, if you had used that strategy before that, you were kind of not making any money, but look at it now. So that's why it's important to be able to know, like, if market structure changes, right? And what happened after COVID? Well, the options markets exploded. And not only has the option markets exploded, they've also exploded with short-term trading. So it's even worse now. So basically, I will be trading, I like to day trade when there's days like this, because I know even if I screw up and I don't know, miss a stop or accidentally buy, an extra tranche when I shouldn't have, or get excited or whatever, all the stupid mistakes we do, you can get bailed out oftentimes when you're trading with the wind like that. If you're looking at the dailies beforehand, you figure out you've got an edge on the dailies, and then you start to trade the next day, and you can be more aggressive, when there's conditions like that. So that's the whole thing. Not sure if anybody has any questions about that. Let's see.
Folks, you can post your questions in the chat room right there. But please post them publicly to everyone. Any questions for Peter?
Good. Hopefully it made sense. Hopefully that just means I explained it good.
Just like anything else, it takes a little bit of time to get absorbed, and it comes from practice.
And just so everybody knows now, where are we at today with this kind of thing? Well, the MACD is curling down now, and we are under the volatility trigger, so we can expect higher volatility, but it's most likely going to be to the downside, because obviously we got the MACD down now.
We have two questions from Avinash and from Randy. Can you hear me okay?
Yep. Avinash says, where can you find the spot gamma indicator that you shared? Spot gamma has a website. If you want to sub to it, you could. I don't, but we have a sub to it, and I post those levels. I'll post them and talk about them. Like if we get that going down to a key level or something like that, I'll say, hey, this is a level we might see support or resistance.
Awesome. Can you guys hear me okay? Can you hear me okay, Peter?
I can hear you fine.
Okay. I just want to make sure you guys understand. We're not related to Spot Gamma.
No, they're not paying. They don't pay us or anything either. Yeah.
We actually pay them. We buy their research. It's very mechanical work. You can probably do most of it, but it takes a lot of time.
That's right. It's very mechanical. There's nothing like horribly I don't know what. Yeah, their vol trigger is a little bit proprietary, but it's not even that is not that crazy to figure out. But you can, this is just stuff that has worked, and frankly, their sub is not that expensive for what it is, and it does save you time. It might take you a while to be calculating some of this stuff, because you got to download the options chain, you got to put it in Excel, you got to roll it back up, make a bunch of charts, and add a bunch to the chart yourself. And it's a lot easier just to have somebody else do the legwork for you, especially if you're trading during the day. It's just, that's the value proposition.
Exactly.
Randy says,
let me address the cost. It's only like $80 a month. So it's like if you're trading 2 or 3 hours a day, it's only about $1 an hour. It's cheaper. Let them do it. What's more important is interpretation. It's understanding and exceptions, things like that, that comes from being in the foxholes, being in the battle zone, and getting some bullets in your back. And that's what Peter comes in. I'm still learning.
So Randy says, do you trade options, futures, or SPI? I trade mostly futures, Randy. I don't touch options that much unless it's something compelling.
Michael has a question for you.
Michael says, is there anything you look for as a signal that a call wall or a put wall is increasingly likely to break? I would say no. Michael, so we talked, we didn't talk a lot about call walls and put walls. There is a tendency for both of them to act as pretty sticky levels. So you could get away with, like, if you closed under the call wall or over the call wall, say like that is that. So just for everybody, like, say their call wall is just where the open interest is highest on the calls. You could probably just download the chain or look at the options chain and see that yourself almost. That's really not a difficult level to understand, but you have to know that just means a lot of people bought calls there, or a lot of people sold calls there, and the market makers are long calls there, right? But you're not going to want the market to trade excessively higher than all those call levels, and then they're going to have to like buy a bunch of calls right when it's trending really, really high. That typically, if you hit a call wall, the market's moving with a lot of momentum and it's really overbought. So that didn't happen today, but typically, if you're closing over a call wall, like we actually closed over a call wall, I think yesterday on the NASDAQ. And it was weird. And it wasn't like the market was like going up a lot. It's just that a lot of calls actually rolled off the books and there weren't a lot higher. So that's a behavior people have. And because the options market changes day to day now, you can get these weird circumstances where you're not even that overbought. We were actually kind of oversold yesterday, and yet we went down again. Well, part of the reason is because people rolled calls down, and market makers said, well, I ain't paying those jokers for that. If everybody thinks the thing's going down, then we'll just push it down. So there's nothing that I look for that says, hey, this level is or isn't going to hold more often than not. I don't know of a great way to do that other than maybe the more times it touches intraday, the more likely it's going to break. But I would look more at how the daily closes are in relation to both the call wall, the put wall, and the vol trigger. And you can gain some information on that that's useful for the subsequent 1 to 2 days of trading. So like if you close over where all the call open interest is, you can expect that it's probably going to try to be weak for the next 1 to 2 days. If you close underneath where all the put open interest is, you can expect that there's going to be some sort of tendency for somebody to want to try to push it up back over that level. So the next 1 to 2 days could be bullish. Now, you do have to be a little bit careful when you get into those cascade events where the market just keeps going down, 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 down. Those are really dangerous areas of the market. We had one last month going into options expiration into August. Tesla was just pull up Tesla's chart, right? Going into like the last few days running into August options expiration, it just absolutely waterfalled, cascaded. And I was trying to buy it during that time frame because I saw that too many people were buying puts. Well, the problem with that is that most of those puts were into monthly options expiration. And if those days going into monthly options expiration now are some of the most volatile days now. Data expiration effect. Those options don't have any time value. They're relatively cheap, and they still carry, some oomph, so to speak, intraday, so that you can move the market around pretty good, especially on a stock like Tesla, where people have been known to manipulate the options market in order to move the stock up and down. But Tesla just cascaded. And that is where you got to be a little bit careful trying to just buy it, even though it closes under the volatility trigger, right? You might be in for a little bit of a drawdown. I like to use exits that are very short term in nature, which just means like hold it for 1 day or 2 days. If it didn't go green, then try to trade again, right? So it can limit your exposure with something like that. So hope that helps. You mentioned there's better momentum indicator uses spot cam indicator. I'm curious to learn what indicator. Oh yeah, CIs are gonna be they're gonna move a little faster, a little sooner than just MACD will. And that MACD is just applied to the daily. The most important concept is not to focus, I don't think, necessarily on the individual indicator, though you would want a good one. You know, like bars indicators are good indicators. They do have edge compared to, you know, your regular MACD or whatever. But the most important thing to focus on is that the momentum is up. Find something that's telling you when the momentum is up. That tells you the market's in a certain condition. And then you can buy what you might call a little dip in the market. And how do you tell it's a little dip? Well, it closed underneath the volatility trigger. And clearly that gives you edge because you can see it in the chart, you know.
Profit, exactly.
So like since COVID, that just buying that and selling it the next day has been 40 or 50% return. And you're only in the market 8% of the time. That's like insane risk-adjusted return, right?
Any other questions for Peter? Last call.
All right. Hopefully that helps.
There's a question from Robbie.
Is it fair to say on the call, put walls and gamma lows to use CI to help? Absolutely, Robbie. Yeah. Yes. So when momentum is up, you would expect support to hold. When momentum is down, you would expect resistance to hold. If that makes sense to you. Yep. And you could trade just that way. Do you trade when this is not working? I trade a lot. There are a million setups. Yeah.
Good question.
This is just one thing, Randy. Yeah. It's just you could use this to be your thing you used. A lot of people don't want to make trading insanely complicated. You know, you just use one thing and then do that one thing. Focus, put your eggs into one thing and watch the basket closely, like Warren Buffett said. But you got to make sure you know when this stops working, right? How would you define when this stops working? For me, if I didn't make a new equity curve high, or if I was treading water for 6 months, I'd be like, this isn't working. I need to try something else. And the market structure constantly changes. You'll hear Fari say this all the time. It constantly changes. This is just a thing right now. It will die. It will fail. It will stop working. That's the only thing you know about market. Nothing works forever. Could you theoretically do this for stocks as well, but longer term trends, maybe finding weekly options? I don't know, Ravi. It's more of a short-term thing because of the way that, you know, like a market maker doesn't really care what happens in 2 months because he sold you that option and he's got like 80% of the value, 90% of the value is just time premium. He's content trying to figure out what's going to happen. He won't worry about it until it gets really close to his strike price, right? We won't start seeing those kind of effects unless the stock makes a big move, which sometimes can happen like with news. And that's one reason why you can get like those big gap up bars, boom, thing gaps up, closes at the highs of the day and then never stops and keeps going. Well, some of that could be options positioning, you know, if it's really, really strong, like short squeezes are exactly like that, you know. They happen both because people are short physically the stock, and increasingly common these days, people are short the options. People have bought a ton of puts need to cover. That happens often too. Maybe very interesting.
By the way, guys, I just went long. Tiny amount.
One could trade the iron condors when not working. Rand, yeah, I mean, there's something to be said for that. If momentum is up and you don't really think the volatility is going to be high, you could sell condors. I like to. One of the things that works well, I think, is cycles of high volatility to low volatility. ADX indicator is good for a timing vol, Randy. So if you get a big high reading on the ADX, then the volatility is very high and the directional move has been very high for a very long time. And then you might bring out the condors expecting that the thing is just gonna, it's it happens often with stocks. They go up, 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 then they go sideways for like a month and a half and digest gains, or they go down, 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 and then they sit and spin and don't do anything for a month. I would be wanting to find those stocks that haven't done anything or are coming off a very highly volatile period to sell options on. Because oftentimes, especially if it's a down move, you can get high IV on the options as well. I don't trade tons of options, but that would be like if you're going to sell not naked puts, but put spreads, finding a stock that had gone down a lot and is now going sideways, and the ADX is usually good for that. High readings.
Any other questions for Peter? Peter, as always, you're a great asset, awesome gem, and you really know your stuff.
So, yeah, thanks, guys.
I really, I enjoy working with you here. You know a lot. I've learned a lot from you, and so keep up the good work. And frankly, I don't know how you do it.
Just spend like 15 hours a day looking at charts, and you can.
Yeah,
you do that too, though.
Yeah, simple solution.
Yeah.
You must get a little bit more than us in terms of hours in a day, right?
Yeah, I have lots of. I spend a lot of time on. I spend too much time doing this. I should stop.
Well, that also shows your passion. And
yes, it's
nothing
not work.
Nothing can happen in this world without a little bit of that, because otherwise
right.
you give up. You get tired. You get other things. Oh, I gotta go watch baseball game. When passion comes in, it clears the fog.
Yeah.
You focus on what you need to do. So that's important. All right, folks. Please join me to thank Peter for another great webinar. We recorded this. We're going to be posting it shortly on our YouTube channel. I will send the link out via Twitter. You're welcome to stay on. This is open for a balance of the day. Okay. Thank you, Peter. Okay. I stopped the recording.